Hey everyone, welcome back for another deep dive. Today we're going to get into something that might seem kind of technical at first, but I promise it's really fascinating stuff. We're talking about the price of capital goods, like why it doesn't always act how we think it should.
And we kind of expect it to always go down, right? Like how computers have gotten so much cheaper and way more powerful over time.
Exactly. You'd think as technology gets better and we get more efficient at making things, the cost of stuff like buildings and machinery would keep dropping. But here's the thing, it doesn't always work like that. The research we're looking at today, especially this paper from the Review of Economic Dynamics, found something pretty surprising.
They use data from the Penn World Tables, which is basically this massive economic database that tracks all kinds of stuff like investment and prices across a ton of countries over time. And what they found is that globally, the relative price of capital, meaning how much consumption you have to give up to get like a unit of capital, doesn't always go down. It goes up about as often as it goes down.
So it's not like this universal law that capital prices always decline, which raises a ton of questions, especially if you're trying to boost economic growth. I mean, if cheaper capital doesn't automatically mean more investment in a booming economy, then what does that mean for policymakers?
Yeah, it's a huge question, and that's what this research tries to figure out. They look at two main ideas about why we see this variation in capital prices across countries. The first one they call the capital hypothesis. Basically, it says that countries where capital prices are declining might be specializing in producing types of capital that are seeing huge productivity growth.
So it's not just about making any kind of capital goods, but about focusing on the ones that are getting more efficient to produce over time. Like maybe those countries are the ones pumping out those ever cheaper, ever more powerful computers we talked about.
Exactly. If you're a country that's killing it at making cutting-edge electronics or highly automated machinery, your relative capital prices might actually go down. The other idea they looked at is the consumption hypothesis. This one focuses more on what's happening in the non-capital sectors of the economy.
So not just factories and machines, but also stuff like services, which tend to grow more slowly.
Right. The idea here is that countries with a lot of those slower growing service industries might actually see their capital prices go up relative to those services.
It's like those service costs become the measuring stick, and if capital goods production isn't getting way more efficient, then those relative prices could actually increase. But how do you test these hypotheses? Did they just look at a bunch of different countries and see what happened?
They went a step further and built this really cool model. We'll keep it simple, don't worry. To simulate how different industries' productivity growth affects capital prices, they used data from the U.S., specifically the NBER-CES manufacturing database, which tracks how much stuff manufacturing industries are producing, and the BEA price index, which measures price changes across the whole economy.
So they're basically setting up a controlled experiment to isolate the impact of industry composition on capital prices. It's like holding everything else constant and just changing that one variable to see what happens.
Exactly. And the key here is that they didn't include things like trade barriers or limits on technology sharing in this model. That way they could really zero in on how the mix of industries within a country, like what they're good at making, drives those price trends.
Okay, I'm hooked. What did this model show? Which hypothesis won out?
The results were super interesting. First of all, the model did an amazing job of matching the real-world data. The price trends it generated were incredibly close to what you see in the Penn World Tables. So that's a big win for the model itself, showing that it captures something real about how these economic forces work.
So it's not just some abstract theoretical thing. It actually reflects what's going on in the real world. That's reassuring.
For sure. But even more interesting was which hypothesis seemed to be the main driver. And it turns out the capital hypothesis was the clear winner. When they simulated NO productivity growth in the non-capital sectors, those slower growing services, it barely changed the model's results. But when they got rid of productivity growth in the capital producing industries, the model's accuracy went way down.
So it really comes down to specializing in those high productivity capital goods, the ones that are constantly getting cheaper and easier to make.
That makes sense. But does this model also explain how much countries are investing? I mean, cheaper capital should, in theory, mean more investment, right? Yeah, that's the logical idea. And to a certain extent, the model was pretty good at predicting investment rates across different countries, at least in terms of the general patterns. However, there was a catch. It tended to underestimate how much investment actually varies from country to country.
So there's something else going on that's influencing investment beyond just the straight-up price of capital. What could that be?
That's where it gets even more interesting. The research suggests that something called the transition dynamics of interest rates is a key factor. Basically, it has to do with how interest rates change over time and how that affects investment decisions.
Okay, that sounds a little complicated. I'm sensing another deep dive coming up to unpack those transition dynamics. But for now, let's get back to the big question, economic growth. Did the model shed any light on why some countries seem to grow faster than others?
This is where things get a bit tricky, and we start to see some of the model's limitations. It was awesome at replicating those capital price trends, and pretty good at predicting overall investment. But when it came to accurately predicting economic growth rates across countries, it didn't quite hit the mark.
So, all this talk about capital prices and investment, and it can't even tell us why some countries are richer than others. That's kind of a bummer.
Well, it's not quite that simple. The model's shortcomings actually point to something important. There's something else happening, something besides just capital prices and pure productivity that's driving economic growth. And figuring out what that something else is where it gets really exciting.
It's like we solved one mystery and found an even bigger one. So what are some of the suspects? Could it be things like the quality of institutions, the ease of doing business, or even cultural factors?
Those are all great possibilities. And it's probably a mix of things, not just one magic answer. But before we go down that rabbit hole, let's take a minute to recap what we've learned so far.
Yeah, that's a good idea. This is a lot to process. All right, so we've figured out that the price of capital, while super important, isn't the whole story when it comes to economic growth. But this paper didn't just stop there. Did they find any connection between those capital price trends and like certain characteristics of a country?
They looked at a whole bunch of things, like how easy it is to start a business in a country, the costs of firing workers, and how developed their financial systems are. They even looked at stuff like intellectual property protection and the level of human capital, basically how skilled and educated the workforce is. It's a pretty wide range of potential factors.
Sounds like they were trying to cover all their bases to see what stood out. Did any of those factors have a strong link to those capital price trends?
Quite a few, actually. For example, countries with stronger property rights protection, where businesses feel safer about their investments, and those with more developed financial systems, which make it easier to get funding for new ventures. They tended to see faster declines in their relative price of capital.
Yeah, that makes sense. If you know your investments are protected and it's easy to get money for new projects, you're probably more likely to use newer, more efficient technologies, which could bring those capital prices down.
Exactly. And here's something really cool. Remember that model we talked about earlier? How it was able to generate similar trends based just on the mix of industries? Well, it didn't actually include any of these institutional factors, yet it still matched the real-world data.
So it's almost like those institutional factors are working in the background. By shaping which industries a country specializes in, if you've got a strong legal system and a solid financial system, you're more likely to attract businesses that produce those high productivity capital goods we were talking about.
That's a really interesting thought, and it opens up a whole new area of research. It suggests that these institutional factors might be way more important than we realized, not just for creating a stable business environment, but for actually shaping the structure of a country's entire economy.
This is getting really cool. But let's not forget about another huge piece of the economic puzzle. Trade countries can just import capital goods, right? So maybe domestic production isn't the only thing that explains those price trends.
You're absolutely right to bring up trade. It's super important. And earlier research did suggest that developing countries especially rely a lot on imported machinery to help them grow. But more recent studies have found a strong correlation between what's imported and what's produced domestically when it comes to capital.
So even if you're importing a lot of your capital goods, the types of capital you choose to import still reflect your overall economic structure. It's not like countries are just randomly importing whatever's cheapest on the global market.
Exactly. And it makes sense if you think about it. Countries tend to specialize in certain industries, and those specializations influence what kinds of capital goods they need, whether they're making those goods themselves or bringing them in from somewhere else.
Okay, I get that. But it's not just about how much they trade, right? This paper also looked at whether changes in trade costs could be affecting those capital price trends. I think that if trade gets cheaper, it would make capital goods more affordable, especially imported ones, which would push those relative prices down. Is that what they found?
It's a logical guess, but it's actually more complicated than that. Remember, trade costs aren't just about tariffs or shipping expenses. They're also about how efficient customs processes are, how reliable the infrastructure is, and how easy it is to do business across borders. And these costs are usually measured relative to how efficient trade is within a country.
So there's like a baseline level of efficiency that sets a limit on how low those trade costs can go.
Precisely. So while declining trade costs might make capital goods cheaper overall, they can't really explain a long-term increase in the relative price of capital. That relative price is all about how the cost of capital goods compares to other stuff in the economy, like those services we talked about.
Got it. But those trade costs could still explain why those relative prices stay high if those costs are always high, right? If it's always expensive to import or even move goods around within a country, that would keep the cost of capital goods up.
That's right. High trade costs can really drag down the economy, making it tougher for businesses to get the capital goods they need at competitive prices. The researchers looked at data on trade costs from the ESCAP World Bank database, which has info on all kinds of trade-related stuff, and they didn't find a clear connection to those capital price trends across countries.
So trade definitely plays a role in all of this. But it doesn't seem to be the main force behind those long-term shifts in the relative price of capital.
That seems to be the case.
However,
They did find something pretty intriguing when they looked at how trade costs affected the model's predictions. Higher trade costs actually led to higher relative capital prices in the model.
wait, really? That's kind of counterintuitive, isn't it? If trade is expensive, shouldn't capital goods be more expensive? Both the ones made domestically and the imported ones. Why would the model show the opposite?
That's the really interesting part. And remember, the model's predictions are based solely on what industries a country specializes in. So this finding suggests that trade costs might be influencing capital prices indirectly by affecting which industries a country focuses on.
So it's another example of those indirect effects we were talking about earlier. High trade costs might make it less appealing for a country to specialize in those high productivity capital goods, because it's harder to export them or even move them around within the country. That might lead them to focus on other industries, which could explain why their relative capital prices are higher.
That's a really sharp observation. It shows just how complex and interconnected these economic relationships are. It's not always a simple case of A causes B. There are often multiple layers of influence at play.
Yeah, I'm starting to see why economics is sometimes called the dismal science. It's fascinating, but man, it's complicated. But hey, we've uncovered some really interesting stuff already. We've seen how institutions and trade can have an impact, even if it's not always a direct one. But before we move on, there's one more thing I want to touch on: how capital is actually defined. This paper mentions that how we define and measure capital can actually matter. Can you talk about that a bit more?
You're right, that's a super important point. It's easy to think that everyone agrees on what capital means, but it's actually more nuanced than that. For instance, the researchers initially focused on industries that make traditional capital goods, like machinery equipment and buildings, the physical stuff we usually associate with investment. But some economists argue that we need to broaden our definition of capital to include things like software.
Especially these days with all the digital stuff going on, software is a huge part of investment for a lot of companies. It's not just about building factories anymore. It's also about developing the software that runs those factories and the businesses that operate in them.
Totally. The paper did look into what happens when you add software to the definition of capital goods. They wanted to see how it would affect the model's predictions.
So what happened to those predictions when they included software as part of capital?
Interestingly, it actually made the model predict slower declines in the relative price of capital.
Really? I would have thought that including software, which has gotten so much cheaper and powerful in recent years, would have made those relative prices drop even faster. Why do you think the model showed the opposite?
Well, remember how the model relies heavily on those industry-specific productivity growth rates? It turns out that productivity growth in software-related industries, while still significant, has generally been lower than for industries that make traditional capital goods like machinery and equipment.
Ah, I see. So even though software has gotten way cheaper and more powerful over time, the pace of those improvements hasn't been as fast as for some of those more traditional capital goods.
Exactly. And when you throw in a slower growing component, it brings down the overall average decline in the relative price of capital.
So it's a good reminder that averages can be misleading. You might have one sector, like software, seeing rapid cost declines. But if other sectors, like traditional manufacturing, are improving even faster, that relative price might not go down as much as you'd think.
Exactly. And while the model's correlations with the actual data were still strong even when they included software, it did change the predictions a bit. It just highlights how important it is to be clear about what we actually mean when we talk about capital and how it affects the economy. Are we just talking about physical stuff?
Yeah.
Or are we including intangible things like software and intellectual property? The answer can really change how we understand those price trends and what they mean for growth.
This is making me realize just how many layers there are to these economic relationships. It's not just about whether the price of capital goes up or down. It's about how we define capital, what kinds of industries are producing it, and how those industries are affected by things like institutions and trade. It's all connected.
It definitely is. And this research does a fantastic job of showing those connections and all the nuances involved. But there's one more piece we should talk about: the role of housing. After all, residential construction is a big part of investment in a lot of countries. Did the researchers look into that at all?
That's a great point. When we talk about investment, we often think about businesses buying new equipment or building factories, but people buying new homes is also a huge form of investment. It's just investment in a different type of capital. Did the researchers have any insights on how housing fits into all of this?
You're right. It's a key point. And the researchers definitely recognize that, unfortunately, good international data on how much housing contributes to new investment is hard to find. It's not something that's consistently tracked across countries the same way business investment is.
That's a shame. It sounds like a big data gap. But they did find some data, right?
They did. They were able to look at the U.S., where data on housing investment is easier to get. And they found that housing makes up about 40% of all new investment.
Wow, that's a huge chunk. Almost half of all new investment.
Exactly. And it suggests that housing might be a much bigger part of the story than we usually think, especially since the returns on housing, like how much people make from investing in homes, can be pretty different from the returns for other types of capital.
It makes sense that investing in housing would be different from, say, investing in a new factory or some software. But without that global data, it's tough to say for sure how much of an impact housing has on those capital price trends and on overall economic growth. It's like a missing piece of the puzzle.
You got it. And this is a perfect example of how limitations in data can sometimes hold us back from fully understanding economics. We might have these great theories and models, but if we don't have the data to support them, it's hard to draw strong conclusions.
So we need better data collection, maybe. If we really want to understand how housing fits into the global economy, we need more comprehensive and consistent data across all countries.
Absolutely. But even with these data gaps, we've learned a lot from this research. We've seen that the relationship between capital prices, investment, and economic growth is much more complex than it might seem at first. It's not just a simple story of cheaper machines leading to more factories and a booming economy.
It's more like a whole web of interconnected factors, with industry composition, productivity growth, institutional quality, trade costs, and even the definition of capital itself all playing a part. And while we've made some headway in understanding these connections, there are definitely still a lot of unanswered questions.
That's the beauty of economics, or really any scientific field. Every answer just leads to more interesting questions.
That's a perfect transition to our final thought-provoking question for our listeners. After this deep dive into capital prices and economic growth, what's the big question they should be thinking about? So we've covered a ton in this deep dive, but it feels like we're just scratching the surface. What's the big takeaway question for our listeners to think about?
You know how we talked about how much consumption you have to give up to get a unit of capital, that whole relative price of capital idea? Well, the researchers used that concept to look into something called the marginal rate of transformation. It sounds kind of complicated, but it's a really interesting way to think about how economies change over time.
Okay, I'm all ears. Break it down for me. What exactly is this marginal rate of transformation, and why should I care?
Basically, it's a way to measure how easily a country can shift its resources from making consumption goods, things people buy and use directly, to making capital goods, things like machines and factories that are used to make other stuff.
So it's like a measure of how flexible an economy is. Like, can they easily ramp up production of capital goods if they need to?
Exactly. And it turns out this marginal rate of transformation is really connected to those industry-level productivity growth rates we keep bringing up. If a country's industries are getting better at making capital goods, it's easier for them to shift resources away from making other things and focus on making those capital goods.
So if you're getting really good at making robots, for example, it becomes easier to move resources from making, say, shoes to making even more robots.
You got it. And what the model showed is that this flexibility, this ability to shift resources, actually changes over time. It's not fixed.
I'm guessing those productivity differences are a big part of that. If some industries are getting much more efficient than others, that would change the balance, right?
Absolutely. Industries that are seeing faster productivity growth naturally become a bigger part of the economy, while those slower growing industries kind of shrink. It's just a natural adjustment.
Which makes sense. If you're getting better and better at making something and people want it, you're going to produce more of it. Is that what economists call structural transformation?
Exactly. It's the process of an economy changing what it focuses on and where its resources go over time, driven by those changes in productivity. And this whole process of structural transformation is a key driver of those long-term changes in the relative price of capital.
So it's not just about what you're making today, it's about how easily you can adapt to new technologies and shifting demands. A country that can quickly switch gears and start producing the most in-demand, the most efficient goods is going to be in a better position to succeed.
That's a great way to put it. And this research really shows how dynamic and interconnected all these economic forces are. There's this constant back and forth between productivity growth, the mix of industries, relative prices, and a country's ability to change and adapt its economy.
It's a lot to think about, but after all this, what's the final mind-blowing question we want to leave our listeners with? What's the big mystery we still haven't cracked?
We've seen how important the price of capital is, but it's just one piece of the puzzle. We've also seen how the mix of industries, productivity growth, things like institutions and trade, they all play a part. But remember how that fancy model, even though it was good at matching those capital price trends, couldn't quite explain why some countries grow faster than others? That's still a mystery.
Right. It seems like there's something else going on. Something else that determines whether a country can turn those investments in capital and those productivity gains into widespread economic success and a higher standard of living for everyone.
So here's the question for our listeners. What else could be happening? What factors might explain why some countries are so much better at turning those ingredients into real economic growth?
It's like we have all these puzzle pieces, but we're still missing a few to see the whole picture.
Exactly. And finding those missing pieces is what's going to help us truly understand how economies work and how we can build more prosperous societies.
Maybe it has to do with the quality of education, making sure people have the skills to thrive in a constantly changing economy. Or maybe it's about having governments that are efficient and transparent, creating a fair playing field for businesses and encouraging innovation. Or maybe it's even about a country's culture, how people view entrepreneurship and taking risks, the willingness to try new things and challenge the way things have always been done.
Those are all really interesting ideas, and it's probably a combination of things, not just one simple solution. That's what makes this so fascinating. There's no easy answer. No magic formula for economic success. It's about understanding all these complex forces and how they work together to create the conditions for sustainable growth and prosperity.
Sounds like economists have their work cut out for them, but it also sounds like a really exciting field to be in.
Absolutely. There's always something new to learn, a new layer to uncover, another puzzle to solve.
So to all our listeners, we leave you with that challenge. Go out there and explore, dig into the research, think critically, and maybe you'll be the one to discover the next piece of this amazing economic puzzle. Thanks for joining us for another deep dive. We'll catch you next time.
Keep on diving.